little bit about me first. Am I doing this right? You all can see the screen.
A little bit. Can you enlarge it? Oh, I got it. I got it.
Okay. So I'm going to roll through this because I'm kind of on a timeline, and I have to time myself because sometimes I wander a little bit. Okay. So 32 years in the business. I got my broker's license in 1988. I'm licensed in the state of Missouri and the state of Texas. I am currently with the Keller Williams Master Faculty. So I teach a number of different classes across the company. And right now, we're in a shifting market. So the shift course is one that I am teaching as well. Over the 2 years, I've completed hundreds of transactions. I'm licensed between affordable to luxury, so I do a little bit of everything. My median price point is right around 300, and I mention that because while that's the price point that I typically sell, I have always served in some capacity as an affordable in affordable housing on the board. For example, now I am on the Houston Community Land Trust Board. So I always find myself in a position where I'm giving back, and I'm currently the president of the Houston Black Real Estate Association, which is practically a full-time job for me. And it's an honor and privilege to serve, and I have a 2-year term, which I will finish at the end of this year. So we talked a little bit about what you all want to learn today, and I will go ahead and Elizabeth, is it Nico?
Just say Nico.
Okay.
Just say Nico. Okay.
So one of the first questions that you said was, okay, well, how do you make money in real estate, right? All money in real estate is made at the point of acquisition. And all transparency, it's really all in how you buy. And right now, the current market, your timing matters, where you buy, how you buy, and what you buy. So that's one of the most important things that you need to know. So when you think about, okay, well, what if I'm doing this wholesaling? I don't want to get a license. What's the other brother's name? I can't see everybody now. You don't want to necessarily invest in a license, but you run across deals, and you might be able to position yourself to be, say, a wholesaler. So then you've got, and normally what a wholesaler does is you are kind of like the bird dog. You find the deal, and you get yourself in the middle. So the person that's selling, and then you have a couple of investors like Dwayne and Mark. You find a good deal. They're good because they are holders. They're building portfolios whereby they're buying and holding. So you've got a margin in there. And what you do is you tie the property up. It's acquisition. You will work with somebody, you run the numbers to make sure there's some equity or leverage in there. So that would require generally having a real estate partner as well, and knowing how to determine the value. So kind of have an idea of what the asset is worth. You have an idea of what they are looking to sell it for. So you actually, in wholesaling, there's a certain type of contract that you get to tie the property up, if you will, to control it. Then you have certain people that are the cash buyers, or they have their system set up, which Dwayne will talk about, how people can be positioned to move quickly as purchasers, right? And you go through a process. Now, I don't have time in this call to go through that whole thing, but that's something that we could address in a full investors workshop. Okay.
Okay.
So about right now, the market, if you are a buyer, it's a great time to buy if you are properly positioned and prepared. So if you've got cash, or if you, and this is more on the residential side, you've kind of got your pre-approval. You've already talked to Dwayne and he's checked you out, and you have a sense of how your asset, your credit, and everything lines up. So you've got a pre-qualification or something that says that you are eligible and ready to buy something. And that matters because in the current environment, believe it or not, it's a seller's market because the inventory is low. So it is still a good time to buy. And then on selling, it's a great time, especially if your property is vacant. Because the biggest downside right now is that the inventory is low. So means you've got all these buyers out, you've got fewer sellers. So what most people are thinking, well, I can just go and steal a deal right now. Well, not so fast, Sherlock. Slow down your gym shoes, because people are not just giving their property away just because we're going through this pandemic. So I'm gonna get into that just a little more. If you're investing, it's a good time. It's an okay time, because in general, in Houston, and Dwayne will tell you this because we work together, it's hard to find a deal because there's so much competition, and because the prices have been steadily going up across the market. So you really, you have to be really bird dogging. And that's where, if Nico, you are really looking to do the wholesaling, if you can get you a good groove on that, being that person who's finding stuff, especially off the market deals for investors, that could be a really good opportunity for you. So just to think about the pandemic itself, it is, uncertainty is the word of the day. We're in unprecedented times, but we have seen a few things where we can make some kind of judgment, right? So first of all, we know that 22 million people have over the last month have filed for unemployment. That matters. We know that over 30,000 people have died. That matters. We know that the pandemic is not Houston, it's a global occurrence. So that matters. And we've got businesses shutting down. So from the vantage point of real estate professionals, because we've got someone here that's saying, oh my God, I'm looking to go into the real estate business. I'd like to start a business. Is this really a good time? Well, watch this. In the state of Texas, real estate has been deemed an essential service. And as always, as we discussed earlier, we are a service-driven profession. Guess what? Death, divorce, employment, transfers, unemployment, changing economies. So, we are always relevant. There's always some kind of activity going on. The key is working with caliber professionals who know the market, understand it, and can adequately interpret it for you and to help you meet your needs. So in March, there was no real impact because the business was already in. But we're projecting into April that the listings are already down by 70%. Property on the market, people deciding whether they will go ahead and make their homes available for sale. But watch this, the builder market still provides adequate almost a surplus of inventory because they've got all these houses that they've started. Some of the deals are falling out, but the pricing is, some of the prices, they're gradually decreasing the prices, but they're doing more in terms of offering incentives to real estate professionals and incentives to purchase with closing costs and things like that. Does that make sense? So whether you're investing or buying for yourself, now is a good time, especially if you want to get a new home, because a lot of resale people, they just not letting you in their house. And with some people, they don't want to, some buyers don't want to go into a resale home because you don't know if the people have health issues who currently live there. So we run into a little bit of that. But some other telltale signs, just having a sense of what's happening in the market. Zillow and Redfin, a lot of people look for houses on Zillow. Well, that traffic is down about 40%, and that makes a difference. You know, we've got the Redfins and Open Doors and some of those real estate companies that actually hire people instead of having just straight commission people. They've been laying people off. Loan applications have reportedly gone down 17.9%. So that matters. So lenders, you know, they're shifting gears, and Dwayne will talk a little bit about this, but you know, Dwayne is one of those lenders who sees all this, you know, people getting out of the business, they can't, their deals are falling through because their company is not behind them, their company is not shifting with the market. But Dwayne's company, New American Funding, is one of the better ones that's stepping up and taking care of people right now. The other thing, if you have property that you've been on the fence about selling, especially in, you know, the low 100s up to about 220, now is the time to get your money because people are out there. Inventory is low. It's historically low. So even if it's a resale, you just have to know how to put it on the market. Does that make sense? Now, some people say, well, with all those people unemployed and, you know, different things falling out, should we get a lot of foreclosures, this and that? Not so fast, Gym Shoes, because the government has a moratorium on foreclosures. And people, I think, this is just me and 32 years of experience, I pretty much know based on some of the demographics that are in the unemployment category, there are going to be people losing their homes, but that's going to be a whole year from now. So right now, I don't think that the market is going to get beat up so badly that people thinking they're going to get these super deals. I just don't. I don't necessarily see that because there are some fail safes that are in place. Again, there may be some people who, you know, in a shorter window, they might be able to help out and, you know, assume a mortgage or different things. But overall, the real estate market is not as vulnerable as you would think under the circumstances. So any questions about that? Was that helpful? Hello? Am I going on and nobody's here?
I can hear you.
Oh, you're good.
Yes, it's helpful.
Very helpful.
Oh, okay, I was wondering because, okay.
I put everybody on mute. So.
Okay, I'm sorry. So I'm just looking at the timing too. I'm going to roll through this because I think the main thing that I really wanted to convey was that it's a good time. Don't be afraid now. The key is, as I'm going to explain real quick, knowing why you're wanting to do something now and how you need to put your team together. So this 11 steps to build wealth through real estate investing, it's just it's a roadmap, and we're not going to get into all of that. Because I'm going to talk about establishing your why, the team, and then Dwayne is going to talk about the financing, okay? But this gives you an idea. So you'll have this, so should we decide to do a follow-up on the investment piece, that's what we'll do. But the why is extremely important, especially if you are looking to invest primarily. So I could ask, why you buying property in Atlanta or Arizona? So again, you want to be very clear, because your why will determine your X's, Z's, and ABCs through the whole process. You know, some people, for example, engage wealth building through real estate to put their children through school. Some people do it for retirement. Some people do it because they always wanted to get into real estate and they're just fascinated. Real estate is sexy, and that's okay because it is, right? So understand what your why is, and that will really be a big plus for you moving forward. Then building your team, extremely critical, because like me right now, over the years, you know, there was a period where I did a little more marketing and advertising. Probably about 90% of my business now is repeat and referral business, okay? And that's because I become a resource to people. So what you are doing, these are your core people that you'll have on your team, whether it's just buying your first home. So it's you, your agent, and your lender. Then once you get more engaged, then you've got your CPA, you know, maybe an attorney and property manager. Okay, but the key is taking the time to connect with people that you know, like, and trust, and that you can work with and move forward with, okay? So this is the point where I kind of turn it over to Dwayne to talk about those next steps, because he will talk about the financing and the money. But again, one of the things that I really do best is the negotiator. That's the class that's my signature class with Keller Williams, negotiating the win-win transaction. So in addition to, you know, helping to locate properties and evaluate value and such, negotiation is a big thing that I do. But I'm going to turn this over to Dwayne now, because I'm about to have some people come in.
Sure. Hi guys, how are you guys doing today? Okay,
Doing well.
I am well. Thank you so much.
Awesome. Thank you.
Here we go. So I'm going to share my screen with you guys. Are you able to see?
Not yet. Yeah, there we go.
About now. Okay. All right, perfect. So one of the things that we wanted to do, like Ms. Parker said, is add value for you guys. So we put together a comprehensive home buyer's guide that gives you kind of the ABCs of buying. It talks about the different players, the different loan programs, what to expect. So I'm just going to run through it real quick, just to kind of give you guys an idea of, you know, from the start to finish, what to expect throughout the home buying process. And feel free to ask any questions. It's open dialogue, so if you guys have questions, just ask. So like Ms. Parker said, you want to start with assembling your team. You want to make sure that your team has your best interests at heart. So interview your realtor, interview your real estate agent. Not every agent is the same. Not every agent provides the same value. So you definitely want to interview your agent, make sure that they are a good representation of what you want. Now, your real estate agent does a lot for you behind the scenes. So your real estate agent, they do the searching, they do the negotiating, they do the contracts for you. And best part is, most people don't know this, you don't pay them. Yeah, the seller actually pays them. So there's a myth that, you know, I shouldn't use an agent because I'm gonna have to pay them, it's gonna cost too much. No, you don't pay the agent, the seller or builder pays the agent. And it's a good idea to get an agent, even if you're purchasing a new build. I can tell you this from personal experience. Don't want to put Ms. Parker on the spot, but whenever I purchased my house, guess who I used? That's right, Ms. Parker. Reason why I use Ms. Parker is I met Ms. Parker 8 years ago, and I introduced her to a client, and she negotiated for the client, and the deal that she got, the client was actually talking to other agents, and they weren't getting anything close to that. So Ms. Parker, master negotiator, I tell everybody that she Jedi mind tricks people into doing what she wants. Ms. Parker's pretty good. So whenever I purchased my house, I went with a new build. And when I walked in, I talked to the builder's rep and I said, hey, you know, is there any wiggle room in this price for negotiating? He looked me straight in the eyes and said, nope, take it or leave it. If you don't want it, we'll send it to the next guy. On my way out, I call Ms. Parker and I say, hey, Ms. Parker, we're at a builder. We really like this house. We don't like the price that they're offering. Can you come talk to them? Within 30 minutes, Ms. Parker came, talked to them, and got us $15,000 off the price that the builder said no negotiating for. So again, it's a good idea to get a real estate agent to represent you even on new builds, because the real estate agent might have access to or have a relationship with builders where if you are eye-walking, they won't give us the same deal. So this talks a little bit about the agent's role. Now, other players, your loan officer, that would be me. A little bit about myself. I'm the branch manager and loan officer for the New American Funding Sugar Land location. I've been doing mortgages for the last 15 years. I've seen it all. Pretty much, we find ways of getting people into homes. We're a direct lender. What that means is we lend our own money. Because we're a direct lender, we do loans that most lenders either won't or can't do. Our guidelines, our requirements aren't as strict as most lenders. And the further along we get into the process, the more I'll talk a little bit about the requirements for each loan program. So your loan officer is your point of contact for the financing. They're the ones who look at income, look at credit, look at assets. They're the ones who tell you your interest rate, how much you're approved for, what your monthly payment's gonna be, your closing costs. So that's your loan officer. Insurance agent. Now, Mark, I don't want to put you on the spot, but do you want to talk a little bit about insurance and what you guys do? Mark?
I definitely unmuted. Okay.
Okay.
There we go. Okay. Yeah, definitely between the realtor helping you find a property and you actually closing the property, you got the, I guess the lender there working on your finances, but you got to have insurance on the house. You want to have insurance so if something was to happen, you know, it can be taken care of. And then the mortgage company wants to make sure they're covered also because they're giving out their money to help you buy that house. So usually I work with a lot of realtors or I work with lenders, and my goal is to find that coverage for you that's going to cover you for the house, but also match what the lender is asking for you to have for coverage wise. So we got to work at what they work with. They say your loan is $200,000. We've got to make sure it's covering that loan and also covering the house for any damages, you know, windstorm, fire, theft, anything like that. So it's kind of where I come in.
Yeah, cool. Now, there is a common misconception. There's a difference between what's known as homeowners or hazard insurance and mortgage insurance. So what Mark does, Mark provides insurance against theft, fire, you know, damages to the property. What mortgage insurance is, mortgage insurance covers against default. So the difference between the two, again, is with what Mark does, he provides insurance against damages, against theft, fire. With mortgage insurance, it's like it's very similar to gap insurance that you get on your car. So if you do less than 20% and God forbid, you know, perfect example, somebody bought a house for $150,000, and you know, something happens and the house is foreclosed on. That person still owes $140,000 for the house, but the lender that they were working with, or the lender that has their mortgage, they were only able to sell it for $120,000. The person who took out the mortgage is still liable for that $20,000 difference, so the mortgage insurance would pay it for them. So that's the difference between mortgage insurance and hazard insurance. Title and settlement officer. So with the title company, the buyer doesn't interact with the title company that much. What the title company does is they insure against any liens or judgments that might have happened prior to you taking possession of the house. So if you buy the house today, you close, you sign, you move in, and 2 weeks from now, someone knocks on the door and they say, hey, you know, I have a lien or a judgment against this house. You need to pay me. The title insurance would pay it for you. Home inspector. So what the home inspector does is they check to see if there's anything wrong with the house. So they check electrical, plumbing. They check to make sure that everything in the house is done to code. As a lender, we don't require a home inspection, but we highly recommend that you do get an inspection for a couple of reasons. You want to make sure that there's nothing wrong with the house before you move in, because if the inspector finds something, you can ask the seller to fix it or give you money to fix it before you move in. If after you move in, you find out that there's stuff wrong, you buy the house as is, so there isn't really anything that you can do after you move in. You can also use the home inspection as a negotiating tool. So again, something comes up and you know the AC is about to go out and it costs $5,000 to replace the AC. You can negotiate with the seller to have them either replace the AC or give you money to replace the AC. So next person involved is the appraiser. What the appraiser does is, the appraiser is the one who determines the value of the home. They go out, they do a physical inspection of the property and make sure everything is in good shape. They base the value on the house on homes that have sold within the last 6 months and within a mile radius. That's what they use to provide comparables for the value of the house. So those are some of the players. Now, pre-approval. With the pre-approval process, your loan officer pre-approves you. What the pre-approval process involves is the loan officer will take a look at your pay stubs, W-2s, tax returns, bank statements, credit, and they'll say, based on this information, based on my review, here's how much you're approved for, here's what your interest rate's gonna be, here's your monthly payment. But if you are talking to a lender, make sure before you start searching, make sure before you submit an offer, make sure you're pre-approved. There's another term that's used as well, it's pre-qualified. The difference between pre-approval and pre-qualification is pre-qualification is the lender or loan officer asking you questions and running the scenario based on that. With the pre-approval, it's them actually looking at the documentation to confirm all the numbers, your credit, your income, your assets. They're confirming everything that you told them. So it's a stronger level of approval. Very important that you get pre-approved before you start searching. You don't want to put yourself in a position where you go out, you find a house, you fall in love with the house, and find out later that you know there's something on your tax returns, or there's something on your pay stubs, or something on your bank statements that could have gotten caught up front. It's an issue now. So very important that you get pre-approved, not pre-qualified, before you start searching. This again talks about the pre-approval process. So making an offer. You've gotten pre-approved, you've given the lender everything that they needed to review. The lender says, yes, you're good to go. You reach out to your agent and you say, Mr. Agent, you know, Ms. Agent, I'm ready to make an offer. The agent will, based on what you're comfortable with, will submit the offer to the seller. So it might be something where it's a purchase price of $200,000. You might say, you know what, I'm gonna offer them the full $200,000, but I want them to give $5,000 in closing costs. Or they're asking $200,000, I want to offer $195,000 and get $2,000 in closing costs. You would work with your agent to come up with the offer that you're comfortable with to present to the seller. Now, things that are involved after your offer has been accepted. Again, it's very important. It's not required, but it's important that you get a home inspection. because you want to make sure everything is done up to code. Everything is good with the house before you move in. After you move in, you can't really go back to the seller and say, hey, Mr. Seller, the AC isn't working, can you fix it? So you want to get a home inspection prior to having everything completed. You have to give what's known as earnest money. So what the earnest money is it says to the seller, Mr. Seller, I'm a serious buyer. I want to give you a good faith deposit to reserve the house so you can take the house off the market and you allow me time to get my financing approved. So with the earnest money, it's usually about 1% of whatever the purchase price is. And again, it's a good faith deposit that you give to the seller to show them that you're a serious buyer and you want them to consider you and take the house off the market. With the earnest money, you get it back as a credit whenever you close. You don't actually get the money back. So just as an example, if you were supposed to bring $10,000 to closing and you gave $1,500 in earnest money, you'd only bring $8,500 because you get a credit back for $1,500. Very important. Once you submit your offer, the clock starts ticking. If your loan officer, your realtor, the title company, any one of the players involved in the process asks for a document or asks for something from you, it's extremely important that you get it back to them right away. When I say right away, I mean in a couple of hours, that day, the next morning at the latest, because the seller is going to accept your offer with the understanding that you're going to be closing by a certain time frame. You're going to be closing by a certain day. If you don't, it puts your earnest money and all the other costs that you've invested in jeopardy. Typically, the seller will say, we'll give you 30 days to close on the purchase, or they'll say, we'll give you 40 days to close on the purchase. If you go beyond that, or if you go close to that, you're essentially violating the contract, and you have to go back to them and say, hey, Mr. Seller, I know I said 30 days, but I need an extra week, I need an extra 2 days, I need an extra 3 days, I need an extra 2 weeks to get the process done. With you providing the loan officer, title company, your agent, anything that they need as soon as possible, it helps alleviate anything that might happen and cuts down on the turn time. So again, if the loan officer, your agent, the title company, they ask for anything, extremely important that you get it back to them right away. Now, say for instance, you submit your offer and the offer isn't accepted. The seller might come back with a counter. It's very typical. That doesn't mean that it's completely off the table. That doesn't mean that the deal is dead. It just means that they didn't agree to what you initially offered, and they're saying, we're not going to accept this, but here's what we're willing to consider. So it might be something along the lines of their sales price is $200,000. You offered $195,000 with $2,000 in closing costs. They might come back and say, no, we're not going to do $195,000. We'll do $198,000 with $2,000 in closing costs. They'll go back and forth, so they'll counter. And you can still counter after they counter. Now, withdrawing your offer. Say, for instance, you give the earnest money, you've gotten the offer accepted, and during the inspection or the option period, you find out that the electrical is bad, plumbing is bad, it needs a new roof, the AC is shot, it's about to go out, and it requires like $40,000 to get all of this stuff taken care of. If you're within your option period, you can cancel and get your money back. What that means is, so say you have an option period, 10-day option period. On day 10, you can wake up and say, you know what, I don't want to do this anymore, cancel, give me my earnest money back. What would happen in that case is, well, let me step back. Whenever you submit your offer, you give 2 checks. You give your earnest money and you give your option check. The earnest money is usually about 1% of whatever the purchase price is. The option check is a smaller amount. It's usually, depending on the price, usually between $150 to $300, $400. Now, if you're within your option period and you want to cancel, you can say, you know what, Mr. Seller, I just decided, this isn't right for me. I don't want to move forward. If you're within the option period, you can cancel and get your earnest money back. They'd still keep the option money, which is a smaller check, but you get your earnest money back. If you're outside of the option period, the main way to get your earnest money back is if you're turned down by the lender. Now, one of the reasons, again, why you want to try to get the documents, anything that the lender asks for, to them as soon as possible is the file has to go through a few different processes, and we're gonna take a look at that in a minute. But you want to do everything in your power on your end to make sure that there's no holdup on your side.
I just want to add in real quick too, with the we operate in the world of contracts and deadlines, and there are some key points in the contract where you put certain dates and numbers in terms of interest rates and the date that the approval has to be done by. And a good realtor is to make sure you have that schedule, that everybody is paying attention to those deadlines, because that's how, because sometimes it might be you just need to extend it. And I'm just going to add one more thing, whether it's investment, residential, or whatever. It's so important to maintain professional integrity throughout the transaction. It could be your best friend or, you know, somebody close to you. You never know how a transaction may take a different turn. You always want to be professional and respectful of the contracts and the deadlines, because it's your money. If you do something or don't do something and you weren't told, then your cousin messed you up because they didn't tell you. But if your cousin told you and you didn't do it, you can't be mad at them. Okay? So that's what I'm going to say about contracts and deadlines.
All right. Now, again, you don't deal that much with the title company, but the title company is responsible for ensuring a clean title. So they make sure that there's no judgments, liens against the property before you close. So Mark talked a little bit about the homeowner's insurance, what his role is, what that side takes care of. It's just it protects against any kind of hazards that could happen to the property. So fire, theft, wind, hail. If you get flood insurance, it protects against that as well. Now, choosing the right loan program. I can tell you that no two scenarios are the same. Something that fits one person might not fit your scenario. One of the responsibilities, one of the roles of the loan officer is to help guide you on what works best for you. It might be a scenario where it's better for you to do down payment assistance. It might be better for you to take a look at doing 5% down or 20% down or 3% down, or if you're a veteran, look at using your VA benefits where you do 0% down. The loan officer's job, the loan officer's responsibility is to help educate you, guide you on the process, what loan works best for your scenario.
So Dwayne, does all investment, do you have to have 20% down if you're an investor?
No, that is a myth. Thank you for bringing that, Ms. Parker. So that's a myth. For investment properties, you don't have to have 20%. Minimum down payment that's required for an investment property, this is on the residential side. Minimum down payment that's required for an investment property is 15% down. Some lenders require at least 25% down, but with us, we go down to 15% for an investment property. Now, something that we also allow for investment properties is we allow you to use the projected rental income to offset the monthly payment. So what that means is if the monthly payment is, say it's $1,000, but your projected rental income is $1,500, we allow you to use up to 75% of that $1,500 to help offset the mortgage payment, which helps reduce your debt to income ratio. Not that many lenders do that. Now, the loan estimate and closing disclosure. So you've started the process, you've gotten pre-approved. One of the things that the loan officer should review with you is either a closing cost worksheet, a fee worksheet, or a loan estimate. What it does is it outlines the loan amount, it outlines the interest rate, the monthly payment, and the cost. It's extremely important that you get all of that done up front, because you don't, again, want to start the process and find out that monthly payment isn't where you expected it, interest rate wasn't where you expected it. So once you start the process, ask the loan officer for a fees worksheet, a loan estimate, or a closing cost worksheet. Now, 3 days prior to your closing, the loan officer is gonna, or not the loan officer, the mortgage company is gonna issue what's known as your closing disclosure. What it does is the first document gives you an estimate of what the number should look like. Your closing disclosure, the initial closing disclosure gives you a better idea of where all the final numbers should be. With the initial estimate, there are costs, there are fees that the loan officer or the mortgage company won't have access to at that time when you start the process. So the further along you get in the process, the more accurate those numbers are, and the more accurate the numbers on the closing disclosures will be. Locking in your interest rate. So when you start the process, you have the ability to do what's known as floating the rate or locking the rate. The difference between the two. Floating the rate literally means, you've started the process, the rates, the day that you looked at starting the process weren't that good because the rates change daily. You have the option of floating the rate, meaning you don't lock the rate in, but you still start the process, you get everything going, it's just the rate's not locked in for you. Or say, for instance, the rates are really good that day, you like the interest rate, you like the payment, you can tell the loan officer to lock. So the difference between the two is floating just says that the rate's not locked in, but you're starting the process. Locking in the interest rate means that you're starting the process and you're telling the loan officer, yes, I like this rate, get it locked in for me right now. I like the payment, get everything locked in and keep it moving. Now, one question that I get asked a lot is it a good time to lock the rate? I tell everybody that it's based on personal preference. So if you're comfortable with the rate, if you're comfortable with the payment, if you're comfortable with everything, how the loan's structured, just lock the rate, don't worry about it. Because what could happen is the rate could go down, but it could also go up. So if you decide to float, whatever the rate is the day that you decide to lock, that's the rate. So if you started it and it was at 3.5% and you decided to float and 3 weeks go by, you have to close in the 4th week and the rate went from 3.5% to 4%, that's the rate at that time. There's no way to go back to the 3.5%. So I tell everybody again, if you like the rate, if you like the interest rate, you like the monthly payment, you like how the loan is structured, just lock, don't worry about it because the rates go up faster than they come down.
And how do you buy down a rate?
Yes, so you have the ability to do what's known as buy discount points. What discount points are prepaid interest that you pay upfront for getting a lower rate. So just as an example, say the interest rate that you qualify for is at 3.5%. You have the option of applying points to get a rate that's lower than the 3.5%. So you can talk to the loan officer and you can say, I know my rate is 3.5% today. If I applied one discount point, what would that look like? And the one discount point might bring your rate down to, let's say it brings it down to a 3.25 or 3.125. So it allows you to pay money up front to get a lower interest rate. With the discount points are beneficial because again, it lowers your interest rate and it's tax deductible. It's considered prepaid interest, so you can write it off on your taxes. Now, one of the important reasons why you should get a loan estimate up front or closing cost worksheet is some lenders automatically apply 1 point to make it seem like you're getting a better deal when you're not. It's a common tactic that I've seen loan officers do because they know that borrowers are more rate conscious than they are cost conscious. So they look at the rate first and then they worry about the cost later. So perfect example, you might talk to lender A and lender A might say, hey, Mr. Smith, your interest rate based on today's pricing is 3.5%. You talk to lender B and they say, your interest rate based on today's pricing is 3.25. In your mind, you might think that lender A is charging you more for the rate because they're offering you 3.5% when lender B is offering you 3.25. What lender B might be doing is they might be automatically applying 1 point to buy the rate down and not telling you. And again, it's a sales tactic that some lenders use because they know that borrowers are rate shopping and people look at the rate first. And then after they start the process, they're like, okay, so let me see the cost. So very important that you get the closing cost worksheet, loan estimate, something up front that shows what the cost is for the loan or something that shows how the loan is going to be structured.
So I have to chime in again, and I hope you don't mind me sharing your experience.
No, go ahead.
So we're in the middle of Dwayne's deal, and he's with Chase at this time. And he went with the lenders, with the builder's lender, because they were giving all these incentives. So
Yes.
I get this call. Dwayne's like, Miss Parker, I am not signing this. I'm not doing it. And Dwayne is real cool, mellow guy. I'm thinking, oh my God, something has happened, because I really think, Dwayne, this is the only time in 8 years where you really just kind of lost your cool. Let me tell you guys what happened. He looked at it and saw all the additional fees, and he said, oh no, it's just too much. So he wound up finding yet another alternative even to Chase that was better. But Dwayne, you want to share with them what you saw embedded those fees, because builders are big right now, and they are really big with pushing people to use their lenders.
Yes. So what the builder said was, okay, if you use our lender, we'll give you $5,000. And I was like, all right, cool, that works. You know, I'll take some free money. So after I talked to the builder's lender, they're like, okay, so we're going to give you the $5,000, but we're going to charge you $12,000 to do the loan. Yeah, it didn't make any sense. And this is very, very common with builders and builders lenders. They'll say they're doing one thing, but in the end, they're not really helping you. It's a way of making it seem like you're getting a better deal when you're not. Because in that case, they're going to give me 5, but then they were going to charge me 12. That didn't make any sense. But if you don't have the knowledge to know that they're hiding money, or they're hiding costs, or they're making it seem like you're getting a good deal when you're really not, then you would think that you're getting a great deal. Because in your mind, you're thinking that, yes, I'm getting a great deal. You know, my builder's taking care of me. They're giving me $5,000 to use their lender. Let me use the lender. Well, again, in reality, they weren't. So great point, Ms. Parker. Talk to your agent, talk to your lender, make sure that you're comparing apples to apples, because again, sometimes it makes it seem like you're getting a better deal when you're not. Now, underwriting and home loan approval. So the FAL goes through a couple of stages. The initial stage is processing. So what the processor does is, the processor is the one who gathers all the documents. So they gather your income, your asset documents, they get your file ready for underwriting. What underwriting does is, they're the ones who review the file. They're the ones who have the final yes or final no on if you're approved. So they review the file based on policies that the government have in place for us as a lender, and company policy. So they make sure that your debt to income ratio is where it needs to be. They make sure that your assets are where they need to be. Make sure that your credit is where it needs to be, per guidelines that are in place for us by the government and guidelines for the company. So underwriting is the department that has the final yes or final no on if you're going to be approved, not the loan officer. What the loan officer does is, they're your guide. So they're the ones who say, you know, based on what I'm reviewing, based on my expertise, you should be fine going through underwriting. You're good. Here are the things that I think underwriting is going to ask for. Let's address it up front, so that when it goes to underwriting, they don't ask a ton of other questions. So again, underwriting is the department that has a final yes or final no on if you're approved. Underwriting is 9 times out of 10 going to come back with conditions. The conditions might be something as simple as a letter of explanation, or an address that shows up on a credit report, or a variation of your name, or explanation on a large deposit that shows up in your bank account. Underwriting is always going to have questions, so don't be too concerned if they come back and they ask you to provide additional information. So you've provided your conditions. The processor has sent your file back to underwriting. Underwriting has reviewed the file, and they say, yes, you know, everything looks good to us. Everything meets our guidelines, our policies. They've signed off on your file, and your file goes to the next stage. The next stage is the document preparation team. So they're the ones who prepare the documents that you're going to be signing at closing. So your documents get sent to the title company. The title company is the one who actually administers the signing for you. So they're the ones who you meet with to go through, physically sign all the documents. They notarize things and they send everything back to the lender to review. So everything's been sent back to the lender reviews it, the lender signs off on everything. Once they review it and sign off on everything, they give authorization to fund the loan. That just means that they've released the money to the title company and they're saying, yes, you're funded, you can get your keys. This is just a little bit of information about funding the loan, which you just went over, moving, packing. Now, one of the things that I wanted to talk a little bit more about is the different loan programs. So there are programs that offer down payment assistance. There are programs that offer 3.5% down. There are programs that offer 3% down. We do FHA loans, that's the Federal Housing Administration. We do conventional loans. We do VA loans. We do USDA loans. Now, small differences between the different loan programs. FHA is more credit friendly. So you don't need perfect credit in order to get approved for an FHA loan. Most lenders right now are between 640 to, I know one lender who is as high as 700. They want to approve you if your credit score is less than 700. And that lender requires you to put 20% down. With us, we go down to at least a 620 credit score for all our programs right now. Yeah, so we just had a recent change. So we go down to 620 credit score for all our loan programs. We have programs where you can do 3.5% down, where you can do 3% down, where you can do down payment assistance. And for our veterans, you can actually do 100% finance. With VA loans, I tell all my veterans, if you're eligible for a VA loan, it's one of the best loan programs out there. Interest rate is typically better than all the other programs. You don't have what's known as mortgage insurance. We talked about it a little bit earlier. You don't have mortgage insurance. You can have the seller pay a good chunk of your cost for you. So very little out-of-pocket expense if the seller agrees to pay it. So again, for all our veterans, I typically tell them, whenever you compare side by side, a VA loan is the best loan program for you. For non-veterans, if your credit is somewhat challenged, we can take a look at FHA loans for you. With the FHA loan, you can do as little as 3.5% down. Again, you don't need perfect credit. With conventional, we can take a look at doing between 3.5 or 3 to 5% down based on your income and based on where the house is located. And again, we also have the down payment assistance programs. Now,
so may I a quick question here, because one of the big thing that's happening now with COVID-19 is the qualifying criteria is changing across different lenders. Some of it, very little of it is really industry, it's these different lenders. So Dwayne, tell me, I think the main thing that we really need to know is, why is New American the hot spot for people now? Because you guys are doing really well.
Yes. So one of the things that the CEO and the president have emphasized is, we're in the business of helping people buy houses. We're not in the business of making money. So our guidelines, our requirement aren't as strict as most lenders, because again, we're in the business of helping people buy houses. If we look at the scenario and we run through the system, you're not considered a high risk loan. Debt to income ratio is where it needs to be. Assets are where they need to be. Income is where it needs to be. Then more than likely we'll approve the loan for you. Yeah, most lenders out there, I feel awkward talking about other lenders, but there are lenders out there that if you're not at 700,
the big banks.
Yes. So there are lenders out there, if you're not at 700 and you're not doing 20% down, they won't do a loan for you.
Hey, Dwayne, I have a question. So why are the big banks and everybody's kind of tightening up right now, even at this point, meaning that interest rates are low and everything else, but they're tightening up the lending requirements? Why is that?
In my opinion, because of the uncertainty of what's going on in the market, they think that the risk for most buyers are too high. So they want the person who has low risk. That person's a 700 credit score. They're going to do 20% down. That person's considered a low risk loan. With us, again, if your debt to income ratio is where it needs to be, your credit's where it needs to be, your assets are where they need to be, then you run it through our system. The system approves you. That's it. So with us, we're direct lender. We're lending our own money. So our guidelines, our requirements aren't as strict as most lenders. With the other lenders, they can do the exact same thing, but they choose not to.
Yeah,
Yes.
it's
So
accountability.
it's all about risk. Risk
Shareholders, yeah, and risk. And there's another thing. It really wasn't that long ago that we had the housing collapse. This particular cycle this time it's different, but there is lingering anxiety, if you will, from that housing market collapse, and that's what Dwayne, that's what the first thing that I sensed, especially when the big banks started reeling in. You know, people, they were dropping deals and just walking away. I'm like, what the what? But yeah, that's I think it's risk and just not wanting to be in that place that they were before.
Yeah.
Okay. Well,
Any other questions, guys?
Step in real quick and say thank you so much again for everybody. What we're going to do is, if we can focus just another quick segment on investing, maybe talk a little bit about why now is an okay and great time to do so, Dwayne, a little bit about what you do personally with the investing and how y'all can help with the funding. Then we will wrap up, and any other questions are welcome. Did I lose everybody? Can you hear me?
I thought I heard you call on Dwayne.
Oh, I didn't hear.
No, all is well. I just said, well, I just wanted
Dwayne,
a moment.
was he done? Were you done with your
Yes,
presentation?
yes. My
Okay.
side's done, Ms. Parker. If anybody has questions, concerns, just let us know.
So I think what Deborah was asking to talk a little bit about the investing side.
Mm-hmm. So I can tell you, I'm an investor, and is now a good time to buy and invest? In my opinion, yes. So for my purposes, I buy houses to keep them. I buy houses, I fix them up, and I rent them. I put a good family in the house, and I rent them. For the ones that I have no intentions of selling them anytime soon. So regardless of what is happening in the market, regardless of what's happening to value, my intentions are to keep them for a while, long term. So the value, if value, not saying that it's happening right now, but if values are affected, it doesn't affect me because I have no intentions of selling anytime soon. An example of this. So I purchased my first house when I was very young. I purchased my first house when I was 21. I bought it for $101,000.
What do you store here?
You broke, I didn't hear you, ma'am.
You see what you install? You see what you install? You see?
Oh, okay.
We are well domestic. Just a moment.
So I purchased a house in 2004, $100,000. I still have that house today. It's almost paid off, and it's worth I'd say probably like $140,000, $150,000 on the low end. So again, with my houses, with my property that I'm purchasing for investment, I have no intentions of selling anytime soon. So regardless of what happens in the market, it doesn't affect me because I'm not selling anytime soon. So is now a great time to buy? In my opinion, absolutely yes. I'm constantly looking for houses that fit my criteria. And if I see anything, I give Ms. Parker a call.
Yes.
So question, Dwayne. So for a guy that's getting in the business right now, we have a house that we still have a mortgage on, and we rent it out back in Memphis, Tennessee. And then we're going to, when we moved here, our goal was just to rent and then find a place where we want to live, give ourselves about 12 months and figure out where we want to go. So once I purchase that house and we move into that house, how does a guy like me that already, okay, I got 2 mortgages right now that I'll be carrying. how does a guy like me get into the investment aspect of, okay, looking for, now, is it, I have to save up a certain amount of cash and do it that way? Or is there alternative lending sources that will be willing to say, okay, you're carrying 2 mortgages already. Are you going to be able to finance something else as an investment property or something? How does a guy like me get into that? If that makes sense.
It depends. It depends. That makes sense. It depends. If you're concerned about debt to income ratio with having 2 mortgages, how we do it is we allow the income, the projected income that you're getting from the new property that you're purchasing to help offset the payment. So we allow up to 75% to offset the payment on the house that you're purchasing. Now, with regards to funds, again, remember, you have to have at least 15% down for an investment property. In addition to that, you have to show that you have enough reserve set up. When reserve is just in case money. So you don't do anything with it. It just shows your ability to maintain the mortgage after you close. So for the investment property, you have to show a certain amount of months in reserve. For your primary residence, you have to show a certain amount in reserve. And for the house that you already own, you have to show a certain amount in months for reserve. The thing that determines that reserve is whenever we take your information and run it through the system will say, yes, you're approved. Here's how much you have to show in reserves. Yeah. Now, if for whatever reason you can't get approved for traditional financing, we have options, we have resources that I can share with you in order to get approved. Yeah. I know a guy.
Yeah, and I will say this about Dwayne. I'm not going to tell them about the guy with the checks today, but you know, again, we operate in a world of contracts and deadlines. It's important to work with people who understand the rules, okay? And you know, occasionally you have to get right to the fence. You don't go over the fence, you get right to the fence, and you know what you have to do to help people out and give people advice. And again, that's why it goes back to when you were in a transaction, because typically, you know, it depends on how long it takes you to find whatever you're looking for. Once you're under contract, you might be anywhere from, say, 2 weeks to 45 days max. That's not a lot of time. So when that loan officer or person is saying, I need this, or they're asking for something, I always tell people, when they say jump, you say how high. You get it to them quickly. And it matters that you are a cooperative and coachable client, because especially when it gets real busy, and you have to imagine, you've got somebody sitting there, they've got a whole pile of files, right? Because typically people are working for more than just you, and they need your stuff. Well, you decide you're going to take 2 or 3 days to get it to them. You know where your file goes? Immediately to the bottom. And they're working with the people who are moving quickly. And guess what? When something a little irky comes up in underwriting in the back room, well, guess what? They're going to take care of the people who have been most cooperative, you know? So it's so important to just fully engage and cooperate throughout the process. And I'm telling you, it happens in a blink. Most people, that's one of the biggest myths, don't you think, Dwayne? People
Yes,
think
absolutely.
they think they can't do it. They think their credit is not good enough. They don't have enough money, and it's going to take forever. Well, actually, it really doesn't, especially when you put together the right team. And that goes right down to your insurance person too. Because when insurance people dilly-dally around, then, you know, somebody else they'll go to somebody else, and they may pay a higher premium or whatever. That's why you want to have your team of established, with established relationships, where you know that your people are going to be taken care of. They get the best of the best in the business, and they are coachable. And I tell people, by the time I finish with you, you'll be able to help a few more people, right?
Yes.
And you know, that's how it is. I just tell them you got to stay out of other people's transactions now once they're working, but and that's how you build a business. For those who are interested in being in the real estate industry, practicing, you take care of the people. You always keep the people first, and the money, accolades, or whatever it is that you're after will come. Real estate has been sensationalized on television, and it's really hard work, and it's intentional work. It's about helping people. It's about wearing a number of different hats. It's about, you know, having staying power, and it's about sometimes saying no. Like I have reached a point where I have severe difficulties dealing with divorces. Divorces can be really just a bit over the top for me. Deborah and I just went through one. I was so happy to get away from that situation. I just, I mean, but you know when to say when. There's always someone that works for. But everybody needs help, and everybody deserves to have quality help, because life keeps happening. And at the end of it, we are in the life keeps happening business. We help people. We have to be solutions driven, and we have to be committed to the mission of getting people from point A to point B. And trust me, they know the difference. People know the difference, and over time you see the difference in, you know, your referrals and repeat business as well. So I'll just say thank you all for taking the time today. It's been my pleasure to provide, I guess, nuggets of wisdom and insights, and, you know, trust God through this pandemic. Appreciate the people on our front line, and above all, stay safe with your families and friends, and, you know, just remember, for some reason, Black people and people of color are dying at a higher rate. So respect that which kills, but trust God.
So I echo Ms. Parker's sentiments. Stay safe, everyone. Enjoy the time that you're spending with your family. Be careful. If there's anything that we can do to help you, any questions, any concerns that we can get addressed for you, use this as a resource. We're more than happy to take a look at things for you. There are no silly questions, so don't feel like, you know, I shouldn't ask this because it's a silly question. There are no silly questions, so use us as a resource. We're happy to provide you with the information, with the knowledge. That's part of our job. It's one of the ways that we give back to our community. So again, if there's anything that we can do to help you assist with the home buying or investing process, please reach out to us.
Yes, and we are open for business. I do go out and show properties on a limited basis.
Yes.
All right, are we all done with questions, my dear friends?
Thank you. This was very helpful. I appreciate all you guys. Thank you.
All right, Jesse. Thank you.
Glad you guys found it informative. Yeah.
It's okay to meet people at bars, Miss Parker.
It takes off, and you know what? God is good. That's all I can say.
Yes, he is. And I got me a team. Look at already.
Look at
all right, let's go. Well, let's do it. We'll make sure you get in the right neighborhoods.
Roger.
Yes.
Okay, well, you guys have a good night. I'm signing off.
Y'all too.
All right.
Good night.
Thank you.
Our
All
next
right.
meeting
Good night.
is in May.